All right, so let me just start by sharing the screen. Just wanted to, can you guys see the screen? Is everyone?
Yes, yeah, we can see the screen.
Thumbs up? Okay, good. All right, so thanks a lot for, thanks a lot for having us. Really sort of excited to be here this afternoon to sort of just kick things off in an intro. My name is Laith. I used to be with the DMZ a lifetime ago. So when I first began working with the DMZ and helped them build sort of the investor relations program. So the capital program, the intros to investors, the office hours, that was me between 2016 to about the beginning of 2019. After that, jumped to Scale Up Ventures, and I worked under one of the partners there, Matt Roberts, for about a year as a senior analyst, and then joined SVB Canada as the senior market development manager, where basically I help lead the early stage and then also work and set up partnerships and relationships with the different sort of programs. So the DMZ is, definitely one of them that we're, currently working with, along with a few sort of other programs across Canada. And we're certainly going for that whole sort of Canada-wide coverage here. And also with me today is Graham. So I'll pass it off to Graham.
Thanks, Laith. First, I got to say is when you say that you worked at the DMZ a lifetime ago and it was in 2009, you do a good job of making me feel pretty old, buddy. So thanks for warming me up there. Yeah, so as Laith mentioned, my name is Graham. I'm a director on the technology banking team here with SVB in Canada, based out of Toronto. Super stoked to get involved with DMZ, obviously well-known organization, heard lots of what you guys have had the benefit of looking at the list of companies that's participating. And the one thing that strikes me is how incredibly diverse they are in terms of like the sectors and the technologies. So it's really, really interesting. I think one of the things that kind of resonates in the context of the conversation we're going to have today, and Laith and I have had the privilege of having some pretty diverse professional experience and work with a ton of different companies at different stages in different sectors. And when you're talking sort of finances and unit economics, one lesson to sort of keep in the back of your mind as we go through here is it's definitely not going to be a one size fits all. So when we're talking ratios and definitions and sort of how to apply it, every industry, every business is going to interpret this differently. I think that the objective is going to be, so what are the tools you need to have in your toolkit? So I think it's that I just want to sort of plant that seed is that depending on sort of, again, business sector, stage, these may sort of resonate a little bit differently, and appreciating that, finance and unit economics is definitely the most riveting conversation you want to have on a Thursday at 4 p.m. So we're going to try to keep it light, but also have the opportunity to have some Q&A and dialogue afterwards. So Laith, I'll turn it back to you.
Yep, thanks, Graham. Yeah, so if you guys have any sort of questions or anything like that, please just drop them in the chat, and then we'll kind of go through them at the end, and we'll try to answer as many questions as we can. And then, as Graham mentioned, definitely not one size fits all. Thankfully, what we've done is we've compiled sort of like a reference sort of slide at the end. So I'll be sharing the slide with the DMZ team by tomorrow. So they'll have like this full slide they can share with you guys. Feel free to circulate. There's a lot of in-depth links there that can sort of help you find the different sort of benchmarks, different sort of questions that may sort of cover the different industries that you guys are working in. So let's get started. Quick through the agenda. We just, we're going to go through an overview of SVB, talk about sort of the KPIs and metrics about sort of businesses. So just sort of what you need to know as a founder. Going to go through sort of unit economics with regards to sort of the different margins and the different expenses, do sort of a break-even analysis, and then wrap it up with sort of some quick thoughts on what you should know as founders with regards to expenses and budgeting, just to kind of figure out like, sort of like the hidden costs that might sort of end up surprising you. And then we'll wrap everything up with a Q&A. Quickly going over the SVB sort of organization. So we've been around since 1983, headquartered in Santa Clara, California. As you can see on the slide, we're pretty much in all sorts of different verticals: hardware infrastructure, software internet, health life sciences, energy resource and innovation, for private equity, venture capital.
Laith?
Yep.
I think your audio is breaking up a little bit. It goes like this low and then increases again. Something wrong with your audio. Are you?
Nope. No, let me just, yeah, I'll just stay closer to the mic, if that helps.
Yeah. Okay. I think that works. Thanks.
Yeah. So I was going to say, so just repeat that. So established 1983, we're across so many different verticals, everything from like hardware, software, life sciences, energy, private equity, and then sort of the newest vertical, which is premium wine, which is just sort of a case of, follow your customers. Some of our clients had very sort of healthy exits and then just went into sort of like the wine business. So why not? We're pretty much, a global, a globally focused innovation and technology bank. So we've got offices everywhere. So we're in 9 different countries. I think 44 different cities. I think according to the last statistics, we bank over 25,000 different companies, and sort of service more than 3,000 different venture capital funds and private equity firms. Some quick stats about the bank itself. There's a lot of numbers here. Not really going to go through all of them, but one thing that I kind of want to showcase, just to kind of give you an idea, that we're not just sort of like a venture debt solution or whatever. We're a more comprehensive sort of banking solution for startups. We'll do loans. So as you can see, we had 36 billion total loans as of Q1 2020. But we also do deposits and investments. So we're actually like a full-fledged technology bank that's here to help companies. So carrying forward as well, just to give you an idea, we also bank a lot of the sort of the main or big name Canadian clients. And for the sake of, I guess, DMZ and sort of making this a little bit more relevant to the DMZ as well, you'll see some alumni there, such as Majuri, you'll see Borrowwell, and you'll see Snap Travel in there as well. And then obviously there's the bigger names there, such as, Shopify, Wave Accounting, Drop, and you'll even see some VC names in there, such as Van Edge, based in Vancouver. So let's talk about KPIs and metrics, and what they are and why are they so important. So essentially, key performance indicators or KPIs, these are basically measurable values that show how effective you are at achieving your objectives. They're basically just how successful you are at reaching your targets, at reaching your goals. They differ from metrics specifically, as metrics are more sort of like a broader version of a KPI. So for example, if you look at, if there's a business that's running a website, one of the metrics would be web traffic, but a KPI would, for example, be downloads. It's a very specific sort of measure. Another way to think about it is every single business will have lots and lots and lots of different metrics, but they will have very few KPIs that they should actually be focusing and sort of following. You have too many KPIs, that means the business doesn't really know what it's doing. It doesn't really have a focus. It doesn't really have sort of a clear understanding of what it's trying to do or how it actually grows its business. So that's the other reason of why they're so important. So without KPIs, without metrics, companies are usually left in the dark, and they just don't know if they're doing well. They don't know how well they're doing, if they are doing well, and they don't know what exactly type of, what type of unit measure that they should actually be measuring with to figure out how well they're actually doing. I don't want to go into sort of how, any deeper than that. Otherwise, we get a little bit philosophical, but that's sort of the approach there. And one thing to note, as you're building your businesses, as you sort of build your companies, you will very much come across all sorts of different metrics, all sorts of different KPIs, and you should keep track of these. You should keep track of these things. However, you should make a very clear distinction between two very different types of metrics. On the one hand, you've got vanity metrics, right? The other one, you've got clarity. Clarity metrics, sometimes referred to as actionable metrics or operational metrics. And I'll break down the two for you. Vanity metrics are very surface level, right? They're very good for appearance. They're amazing to kind of, create partnerships or create following, create an impact or influencing, or sort of like an influence in the market. Think of the slides that we just went through. So we're talking of, we mentioned a few stats about, the bank, how many clients we have, the amount of loans that we have, or the deposits that we have. Just, those were vanity metrics. And the reason why those are vanity metrics is they're very surface level. They give you just an idea. They give you sort of just the right amount of information for you to just know about an organization. With clarity metrics, however, you've got a more in-depth view into the company, and you can actually understand how the company ticks, how it actually operates, and how it actually works. And with these types of metrics, you're actually also able to do and take critical decisions for your company. So, for example, we look at a company where they're kind of showcasing their downloads and their number of registered users. Those are 2 bits of information. Though they're great, I can't really decide what to do with that. There's not much to go by. Whereas if I'm going by, for example, a CAC LTV ratio, or if I'm going by churn, i.e. the number of people that I'm losing every month, week, year, whatever, those are actual metrics that I can actually create decisions and base decisions on for my business. Therefore, clarity metrics, they're more operational in nature. First round capital describes them as hidden gears that drive growth. So that's something that you guys should just sort of have a distinction on. And as you build your businesses, you will start to learn more and more about sort of vanity versus clarity metrics. Just one key thing to kind of notice, to kind of make note of here. So Fred Wilson of Union Square Ventures had mentioned that you can use something called the 30-10-10 rule to actually pull insights from a vanity metric. So for example, you can kind of see the example below of 30% of downloads or registered users are active once a month. 10% of those are active once a day. And then 10% of those are going to be your actual recurring users. So from that, you're kind of able to kind of pull a little bit more insight, build a little more sort of decisions, talk to your operations, talk to your UI, UX people, and figure out what you should do next or what you should do with this piece of information. Kind of talk about how these different metrics sort of play together and how they kind of fit together in the overall scheme of things. You'll notice that we put revenue, bookings, and sort of sort of pipeline in the top line sort of category, because these are, at the end of the day, they're surface level. Revenue is an output of your process. Right? Revenue is a great metric, but it's an output of actually making the right decisions, growing your business the right way, scaling, and sort of targeting the right customers. Same thing with bookings, same thing with pipeline. It's just about filtering, who you're going after, and how you're actually able to get that revenue. The value creation that actually is generated, that's actually generated by your business, lies specifically in the metrics such as the CAC LTV, or the customer acquisition cost and the lifetime value of a customer. So CAC LTV provides a cost benefit analysis of the process you're using to get and retain customers, right? Churn is another great sort of great metric for your business. It's basically the percentage of customers who just cancel or just won't come back. These are customers that you will bleed out, or sort of you will leak every month, day, week, quarter, year, etc. And the entire idea is that between CAC LTV and churn, you have another metric that's sort of born out of the three, which is retention. So the number of customers that you're actually able to retain. And as a result of the retention, you get referrals, which feeds back into the top line. Those two layers sort of combine and give you the fuel that you need to keep running your business. Hence elongating your runway, which is how much time you have before your cash runs out, and essentially slows down your burn rate because you're generating that revenue. So how fast you're burning through your cash.
Laith, can I just jump in before we switch slides here?
Yep.
Just a little bit of context and from maybe from an SMB perspective. One thing that's really important is, understanding that there's kind of two primary audiences when you're talking about KPIs and metrics. Yourself, in terms of how you're going to manage your business, and by yourself, I mean your team and sort of internally, as well as externally when you're thinking about investors or partners, whether it's debt or equity or grants. I think it's really important to understand how you articulate these and what stories these are telling. One piece that's interesting, and I'll use top line as a quick example here. Said another way, this is traction. You guys are going to talk about traction all day, every day. And there's different ways to articulate traction depending on your business model. So in some businesses, revenue shows up on your books very quickly because you sell the thing, you implement it, the person has it, you get to recognize that revenue. So revenue shows up. In some organizations, maybe you sign a contract, but it's going to take 6 months to implement a software or to sort of manufacture the widget and ship it. So you might have a signed contract, but you don't get to recognize that revenue for 6 months. So bookings may actually be a better indicator of your traction to date. Mm-hmm. The obvious extension of that, of course, is, as Leif mentioned, is pipeline and understanding, once you sign a contract, that's like, we have a commercial agreement. Before that, it's, have you signed an LOI? How sort of advanced are they? So I think the important thing here is understanding, depending on the nature of your business, what story are you going to be telling externally, and what's important for you to track internally as it relates to traction. The same philosophy applies elsewhere. And I think one of the things that, Leif and I talked about beforehand is you Google into oblivion and you'll find definitely the plain vanilla formulas. And we'll talk about them a little bit here for sort of CAC and LTV and churn, but there's iterations of every single one of them. So there's different ways to tackle these. And some are going to make more sense for your business than others. I'll give you churn. Churn is, on the surface, one of the simplest things to calculate. As you start thinking about are we calculating sort of, if the denominator, the bottom number is it the number of users we had at the beginning or at the end of the month? Is it the average? Is it sort of over a 3-month period or 1 month period or a 12-month period? So there's a few different ways to slice the pie when you're assessing these metrics. And it's relevant because you need to know how these metrics align for your business. And yes, part of it's telling a story externally, but it's also important that these are metrics that make sense to you and your business. I think the one which is a little bit less open to interpretation and is more objective is burn rate and runway. And these are critical for you to know at every stage of the business. And I think from SUB's perspective, not only are we looking for this quantitatively to sort of look at what the number is, it's also important to understand that a founder and their finance team understands how to think about burn rate, how they think about runway. They understand sort of the variables that are going to impact this. So, sorry, I jumped in there. I'll turn it back to you later, but I just want to add a little bit of context about how there is kind of a breadth of elements here.
Yeah, no, and I was just gonna add to that. So burn rate and runway are very much objective metrics. They pretty much apply across all sorts of different industries, all sorts of different stages. So burn rate, runway both of them actually don't really care neither about your, the stage of company you're in, nor your vertical. They might change, but burn rate is at the end of the day, how fast you're burning and expensing through your cash. Runway is just how much time you have before it all runs out. Investors, really want, founders that can kind of understand these two elements and sort of will start fundraising accordingly. We'll plan accordingly. We'll figure out sort of alternatives, scenario A, scenario B, scenario C, D, E, etc. Backup plans, all these different things. And I think, if we're able to kind of come back and do sort of a fundraising or fundraising 101 type session, we can actually talk a little bit more about burn rate, runway. We can talk about how venture debt sort of can actually extend those, how raising a round can actually extend those as well. But what the implications are when you do raise a round. But I won't get into those. Churn is something. Yep.
There's a question from Tessa. Do you want to take a question now?
Sure. Okay.
Hello. Sorry, I just had a quick question. Could you talk about the connection between KPIs and OKRs? Yeah, we've been working on or thinking about OKRs a little bit, and so I'm just trying to kind of connect and marry the two.
Right. So I think, oh my God, like I had this conversation a few weeks ago. KPIs and OKRs are actually, so they are very much related. So you've got sort of going from wide to sort of narrow. You've got metrics, and you've got KPIs. So KPIs are basically the success drivers, or sort of like the success measurements of the business, whether you're actually on track and how well you're actually achieving those goals. We just covered that. OKRs are essentially how the different sort of employees and the different business units within the company are tied and responsible for sort of helping achieve those KPIs. So it's sort of, I guess the best way to describe it would be the KPI is sort of like the overarching sort of mission and objective, and the OKRs are actually built underneath it and sort of given out in terms of responsibility across the different sort of employees. And a great example actually for this was the DMZ. So when I was working there with one of my managers, we had OKRs, and we would tie our OKRs to the different sort of objectives and goals of the overall DMZ. So when you're actually writing out your own sort of employee, at the end of the day, like when you're going through the employee review, you're actually sort of, yes, you're coming up with your own goals and objectives, but at the end of the day, you need to kind of describe, well, these goals are great. How do they tie to the overall mission? How do they tie to the overall sort of objectives that we're trying to achieve? So they tie to the KPIs, but they also tie to the overall sort of, I guess, mission, vision of the company as well. So hopefully that answers your question.
Thank you. Oh, sorry, go ahead.
No, it's just because one tiny little rule that I've always applied for OKRs and KPIs, and this is less detailed and accurate than LACE, but it's a simple rule I keep in mind, is OKRs are forward-looking, KPIs are sort of in hindsight. You're now analyzing what you did. OKRs are like setting objectives looking forward.
Yep.
LACE is right. They overlap.
Yeah.
But that's my simple brain trying to.
That's actually great. That's actually a great addition. All right. So just moving on, the LTV CAC ratio. So this is probably one of the more sort of critical ratios that investors, I guess, not just your VCs that are sitting in the boardrooms, but like also angels, especially savvy angels, like the really great angels, financiers, consultants sort of like look at in a very sort of serious way. And it basically is just trying to understand the lifetime value that you're actually getting from your customers with respect to the cost of acquisition of those customers. That's plainly, it's literally as simple as that. It's how much value am I getting from a customer that I'm trying to pay and acquire. There's a bunch of equations on this slide, and I don't want to go through all of them because I don't want to turn this into sort of like a math lecture. But essentially, when you're trying to calculate sort of the cost of acquisition, acquiring a customer, you're going through your cost of sales, your cost of marketing, and then you're basically dividing that over the new customers acquired. I've put a little sort of note saying there's some elements to consider for CAC. So the sort of the cost of sales and the cost of marketing. For LTV, it's literally just sort of figuring out the value times the average customer lifespan. So how much you're actually getting from them versus how long that they're actually going to be there with you as a customer. The most important thing that I kind of want to talk about in this entire slide is the benchmarks right at the bottom. So across all sorts of different literature, it's been found that the ideal ratio is a 3-to-1. Right? So when you actually divide them, you get an LTV CAC of about 3-to-1. So you're getting 3 times as much value from a customer versus the 1x that you're actually spending on them, trying to acquire them. So pausing there for a second on that ratio of 3-to-1. As first-time founders or as early-stage founders, you're not going to be 3-to-1 right now. You're probably going to be closer to 1-to-1. Or in a more realistic sense, it's probably going to be less than 1-to-1. And that's not necessarily a bad thing. It's that you're still building out your company and you're still sort of figuring out, you're still in that phase where you're trying to first, where you're trying to identify who your clients are, what this ideal customer profile is. You're trying to validate your product. You're trying to figure out the messaging. You're trying to figure out all these different costs that are coming, that are sort of associated with it. Therefore, it's, you're definitely sort of in the less than 1-to-1 sort of ratio area, just because of the early stage ness of your companies. And the flip side of this is sort of true, and I'll sort of ping Graham right at the end of this sentence. Sometimes having a ratio higher than 3-to-1 also might not be like a really great sort of situation to be in. It could mean that you're just simply not spending enough on sales and marketing, and that you're missing out on potential customers. But I'll defer to Graham on this point because there's a specific scenario that they've had with a few customers.
Yeah, Lath is bang on. Again, stage of the business, nature of the business. There's going to be a variety of numbers that are going to make sense. Golden rule 3-to-1 totally stands, and there's some that are going to be much, much higher, some lower. Lower you get, obviously, is you need to justify that. So whether it's a lost leader or, early on in the business. There's a company that I've been talking to recently that's based in Vancouver, and they're in the meal delivery, sort of meal kit business. And their LTV to CAC is their 1 year is upwards of 8-to-1, and their 2 year is upwards of 12-to-1. And part of this, as you can imagine, is what is the duration of your lifetime value and how much confidence do you have in that? Because if you've only been operating for 6 months, it's hard to make the claim that you've got a 5-year lifetime value sort of calc, right? So I think in this case where they've got inertia, they've been operating for a while, they understand the tenure of clients once they join and their stickiness, and they've kind of fine-tuned their sales and marketing to the point where they are aware of the fact that they're not underspending or overspending. They've kind of fine-tuned it to the point where this is what they need to spend to sort of attract and retain. So I think there's an opportunity to get to those larger numbers. That's particularly true when you've got longer lifetime value and repetitive purchases. And I think the more mature a business gets, the more confident that number can be as you fine-tune your sales and marketing expense.
All right. And so moving on to the next slide. Yeah. So this is sort of, I think this is what I wanted to mention on this particular slide is, yes, there is churn, there is LTV CAC, there is revenues, there is, burn, runway, etc. There's a lot more, there's so many different metrics out there, and they're tied to so many different businesses and so many different verticals. Andreessen Horowitz has a great article where they kind of highlight all these different metrics across different sort of business units. I've taken some of them, put them on this slide. Obviously, when this deck is shared with you, you guys can just kind of click through on that and kind of go through the article yourselves. It's really great. They go over all these different metrics and kind of highlight as to why they think these things are important. But to kind of go through a few, we've got bookings versus revenues. We just talked about those earlier. We've got annual recurring revenue and monthly recurring revenue. So these you're going to start seeing. I think this second bullet point here, you're going to start seeing a whole lot more while at the DMZ. If you're a marketplace, you're probably going to see the gross version of that for the marketplaces. Later on, you might start seeing, if you're dealing with contracts, if you're dealing sort of like with delayed sort of payments, you're going to start seeing unearned, deferred, and billings. But for the most part, you're probably going to see ARR and MRR, and you're going to start hearing that more and more. And just sort of the key distinction there is just to kind of leave out sort of any consulting or service or installation or sort of like one-time fees. Some founders make the mistake of including those. Especially if it's included in MRR and then they just times it by 12 to kind of get an annual figure. Don't do that. As a previous analyst, it was my job to kind of figure those things out. and then we'll come ask you those questions. In terms of bookings and revenues, LOIs, verbal agreements, they don't count. They're great. They don't count as a metric just because they just haven't happened yet. But if you do have sort of like a contract signed and it's actually going to start realizing, that's a different story. But being like, we've talked to 6 people and they're down to start purchasing. That doesn't really fly. So this is on the business financial side of things. Product engagement, you're going to start seeing things like active users. You're going to start seeing a lot of month over month or year over year sort of metrics. That's something that a lot of investors actually want to look at. And there's going to be sort of, I forgot what the rhythm actually was, but I think it was something like triple, or it was like double, triple, something like that in terms of like the rhythm that they're looking for in terms of growth. And then you've got your sort of generic sort of metrics such as like downloads or sort of like registrations, something like that, or subscriptions. So to move to the next slide, I'll pass it over to Graham now for sort of unit economics.
I know you guys have heard all about the exciting world of sort of metrics and KPIs. What could be more exciting than unit economics? We're going to talk margins, and this is where I get to nerd out. Where you guys are unfortunate to find out that I'm a management accountant by training, so I'm going to get a little nerdy on you. So the first Laith ruined my surprise because if you jump the slide, I was going to ask everybody when you hear I hope no one saw that. I was going to say, when you hear the word margins, sort of what comes to mind? Because I know that the term margins gets thrown around a lot when you're launching a business and thinking about finances. So I'm just curious, like, you just saw the cheat slide, but I'm curious, when you hear the word margins, what are the things that come to mind? I just want to sort of, level set what folks are thinking about when they hear that. Either fire it up in the chat or unmute and away you go.
You can just unmute.
What's left over after cost?
What's left over after cost? I love it. Bang on. There's layers to this. Okay. Anyone else?
I usually just think profit.
Just profit. I love it. Need margins to make money. I love it. Okay. So let's go to the next slide, because obviously all of that is right. But I think there's different margins and they tell you different things about your business. And if anyone asks you, tell me about the margins of your business, it's good to understand what is, again, going to tell the best story that's reflective of stage of your business and what you're working on. There's 3 I'm going to talk about. 2 are cousins: gross margin and contribution margin. Most of the time when someone asks you as a startup what your margins are, they're referring to gross margin. And this is your gross profit, which is revenue less your cost of goods sold, gross profit divided by revenue. This is a critical number to know. And why is because it's an indicator of the underlying profitability of your business. So I'm going to throw a few numbers at you in terms of reference points. And none of these are going to be too surprising, but if your gross margins are less than 30%, you got some pretty skinny margins. You're probably selling a hardware, a widget, but less than 30% is very skinny. So very, very thin margins. 30 to 50%, you've got yourself a business, you've got yourself a viable business that's going to probably start pushing cash south and covering operating costs. Yeah. 50 to 75%, you're cooking. You got something that's going to be pretty profitable business. And then over 75%, this is top end profitability. These are sort of top end software companies that have dialed in their business and economic models. So paying attention to these even early on in your business is critical. The next is contribution margin. We're going to talk about it a little bit more. This is kind of like gross margin's cousin. One of the differences is gross margin and contribution margin both start with your revenue. You're sort of the price you're getting per thing. The next down is where the change is. Cost of goods sold is an accounting term, which is going to take into account a broader set of costs than contribution margin is. Contribution margin is specifically looking at your variable costs. So the cost to make the next thing, it's much, much stricter. And one of the differences between gross margin and contribution margin is gross margin comes from financial accounting, which is kind of born out of telling you what happened. Contribution margin comes out of management accounting, which is helping you run analysis to make go-forward decisions. I'm going to get into contribution margin a little bit more on the second slide, the next slide. Profit margin, generally in finance, one of the most commonly used profitability ratios. This is going to be, and again, people will refer to this a little bit differently. If you talk about public market, large companies, it's most often net income divided by revenue. In startup world, you often will hear folks talk about operating income divided by revenue, or EBITDA divided by revenue, or sometimes even cash flow divided by revenue. So I think profit margin's helpful early on in the business. If you have a cash burning company, which is really common, profit margin's not going to be a number people are necessarily asking you for. This becomes much more important the later you get in your business, but is of course something to keep an eye on. Let's go on to the next slide there, Leif. So bear with me, the next few slides, again, we're going to nerd out a little bit on kind of some fundamental unit economics. And again, this is a useful approach regardless of the business you're in and regardless of what you're selling. This was born out of kind of plain vanilla manufacturing, making widgets and selling them, but it is applicable and the philosophy is relevant. So this goes back to, again, your per unit cost and your per unit price and your revenue, fairly straightforward. This is what you can sell your thing for. The distinction with unit economics is focusing on understanding cost behavior, fixed costs and variable costs. I'm going to give you the strictest definitions and acknowledge that there is gray area in between. The strictest definition, fixed cost is the easiest. This is your operating cost, your overhead. These are costs that do not change no matter how many things you sell. Variable cost, the strictest definition is, it is a cost that only increases when you sell one more thing. That's an important definition because when you think about sales costs, right? If you have a salesperson, are you paying them commission per unit? If it's not commission per unit, then it's not really a variable cost because it's a fixed cost because you're going to pay them that salary, for example, regardless of how many things they sell. Just as a reference. The reality is, of course, there's things in the middle where it's like batch costs, where you can make 10 of a thing, or you need to sort of invest in a project to sort of launch a product or whatever, where there's going to be sort of again, this kind of middle zone where you can make 100 things with one set of costs. Why this is relevant is when you're early on and you're thinking about expenses and costs, how those costs behave depending on how you scale is really important. Again, there's no sort of super right or wrong answer here. It's just important to think about cost behavior because this is critical as we're going to get a little bit more into sort of the economics of startups. It's really important as you think about scaling and making sure that you've got enough cash in the business to walk through a variety of situations. If we go to the next slide, it'll kind of help paint this a little bit more succinctly. So in the world of management accounting, cost volume profit analysis, or CVP analysis, if you want another acronym in your lexicon, this is kind of a cornerstone. And what this is really trying to do is talk to you about what's your break even? How many things do you need to sell to sort of be cash flow neutral, or at least have a good sense of how much you're going to burn in different scenarios? So the first two, quick analysis, break even, when your revenue is equal to your total costs. Profitability is when your revenue is higher than your total costs. So the analysis is you take your contribution margin, which again is, we'll do the unit break-even analysis. So on a per unit basis, you take your unit revenue. This is how much you get paid per thing, the variable cost for that thing, and what's left over is your contribution margin. This is how much money you have to contribute per unit to your fixed overhead. This is a really, really important number. And the break even, the number of units you need to sell, another very important number is just the total fixed costs divided by the per unit contribution margin. This is how many units you need to sell to get those contribution margins up to cover those fixed costs. This is obviously a relevant tool. You can flip this exact same formula around a few ways to understand how much you're going to burn. What do you need your contribution margin to break even? You can do the same analysis, not just on a per unit basis, but based on your total number of units. So based on a forecast. So I think these are, again, tools in the toolkit. There's a few different ways to slice this, but the real sort of the takeaway is understanding where you need to be to break even is a really helpful number to know. And how much money you're contributing to your fixed overhead per unit you sell is another really important number to know. So I'll leave that one there. Leif, Is that? I think we're switching back up to Leith here.
Yep. Was just making sure that I'm unmuted. All right. Okay. So right now, just want to talk about something sort of very particular to startups, which is the sort of the expenses that you should kind of keep in mind as you're actually building your business. And I'll start off by saying, I'll start off with this quick sort of, this quick comment where, according to a CV Insights survey that they've conducted, they found that actually 1/3 of startups fail due to running out of cash, and that's usually because of the burn, and because they actually don't really sort of account for the burn, they don't account for the runway, and they don't sort of really think about the expenses. Oh, okay. So I'll just repeat that to everybody just because I got a note. So 1/3 of startups fail due to running out of cash. Essentially, it's just them not accounting for their burn rate, nor accounting for the runway. This is something that sort of CV Insights found. There's a link to the survey there that kind of also highlights all the different sort of other reasons why they fail. But this was one of the main sort of reasons that kind of stands out and is very much sort of related to this presentation. The other thing is, figuring out these costs doesn't really mean you're going to make it. It doesn't really mean you're in the clear. It gives you a more sort of clearer picture of what's going on with your company, and it means that you're going to have to start making sort of decisions on strategic decisions, tactical decisions on how you want to run your business and how you want to steer the ship to kind of keep things afloat. So what we found, and sort of what's really sort of worth talking about, are kind of 4 different categories of costs. You've got talent, marketing, customer acquisition, which we've talked about, technology and office, and sort of administrative. Talent costs, basically, this is the big one, specifically for startups. As we're in startup world, you don't really have that many sort of physical assets nowadays, specifically with work from home and being remote. Essentially, you've got employees are the sort of like the big chunk on that expense list. So employees actually account for one of the biggest parts of the budget, and sometimes they're actually potentially more than 50% of that expense. That's actually just something to think about. Because you're hiring talent, you're trying to poach talent from other companies, other startups, and other bigger companies. You have to pony up that cash. They're going to be expensive. Sales personnel and developers just do not come cheap, and I think they don't come cheap anywhere. Not unless you outsource, but then that opens up a whole can of worms in and of itself. And obviously, don't forget the benefits, the insurance, vacation, matching, all that stuff. That also just starts piling on more and more, especially as you start to scale and grow. When you go from a 5-person shop to a 20-person shop to a 50-person shop to 100-person to 500, etc. I think this is the one that I wanted to stress on the most, just because founders in general just don't really sort of take that, take bullet points number 2 and 3 into costs much. There are tools out there to kind of help you figure out what the base salaries here and there are, like in different sort of regions, so that you can actually try to find them accordingly. Marketing, customer acquisition, we kind of talked about those up in KPIs and sort of metrics, but basically it's just your ad spend and your marketing spend, so that you can actually start promoting and you actually start going after all these different clients. In the beginning, I assume, so quick note, that's marketing and sales tends to spike in a few ways. It spikes in the very beginning when you're actually still trying to figure out who your customers are, where they are, what the ideal customer profile is, the different demographics, region, age, gender, etc., all these different things, as you're trying to build up that sort of identity and actually go after them. And it actually costs money to actually do all those different things. The other times it actually spikes would be post sort of raising around, or when you're trying to expand into different sort of geographies. You need to make noise. You've just raised around. You need more. You need more users now. The pressure's on. So that just starts to spike a little bit more. Technology and office, as well as administrative, those are sort of the slow ones, but they can also creep and become massive expenses if they're not sort of kept in check and not really sort of accounted for. Nowadays, though, you don't really have to worry about office because everybody's sort of work from home, unless you actually do have your own office, at which case more and more companies are sort of reconsidering that. But that's a whole different conversation in and of itself. So it really just comes down to the technology. What kind of stack are you running? What kind of cloud service are you using? What kind of subscriptions are you running? Also very, very much worthwhile to keep those in check, just because they will snowball. Here's the great thing, though, being part of the DMZ, or being part of one of the accelerators of different programs, most of them will have connections, perks, and advantages. So you'll get like free credits with cloud services, or you'll get like a discounted subscription for like a year. Make use of that. And it's the same.
Sorry to interrupt.
Our clients as well. Oh, yep.
I've got a question. Actually, for both yourself and Graham, I have two questions, and I don't want to go too far down. This is Peter.
Yep.
The first one is, when it comes to talent costs, it sounds like as new tech companies, we have to front end load, making sure we've got good talent. Talent wants to be cherry picked, right? Now, do investors know that talent costs will run around the 50% mark, like you said, or of that budget line? That's question number one. Are investors aware of that that's where their investment will be going to? And question number two, I think, Graham, you said something about commission. And if you're hiring salespeople, commission is a variable cost. Now, I just want to get your thoughts on using equity as an incentive for salespeople. Those two questions, please. Thanks.
Sure. Okay. So, question number one: do they know that it's going to be a large chunk of your budget? The short answer is yes. So typically for the seed round, typically in like your very early stage rounds, you're raising because you're trying to hire talent. It's not like you don't raise a seed to expand to a different country. You raise a seed so that you can actually expand your team, and you raise your Series A to actually expand your team further. It's usually B and C and beyond is when you actually start thinking about like geographic expansions. When you probably, when you properly, find your footing. But in terms of budgets, and in terms of sort of understanding that is the bigger chunk, yes.
So when you're putting the business plan together, the emphasis should be on creating the team at the seed. Is that should be part of the plan, right? Yes,
but it's also making sure that that you're balancing out and not over hiring at the earlier stage. That you're hiring, obviously you don't want to hire 16 people, at like the seed, for example. You're looking for like maybe 1, 2, maybe the maximum of 3 sort of like rock stars to kind of come in and really help you build your company. But yes, there is an understanding that like yes, we will need this cash to hire and bring in talent that will help us grow and scale the company. The entire message is that we are doing X so that we can grow and scale the company, so that we can generate more revenue, so we can, find more and more investors, so that, your shares in the company will increase in value. That's sort of the main message that you're kind of sending them. On the second question, for Graham, yeah.
I'll jump in on the sort of commission front. Maybe one thing I'll add, just sort of on the tail end of that, to Laith's point, it depends on the stage of the business. And I think if you're looking at an early stage business, right at the get-go, you're in kind of ideation, idea formation, minimum viable product, where like you're trying to prove you got a thing. Kind of pre-Series A, let's call it, leading up to a seed, friends and family, you're really working on product market fit. So what do you need? That you need to develop a product. So if it's software, it's going to be developers. If it's hardware, you're going to need engineers, people to design it. And you're also going to need to sort of get it into market. So I think that's where, most of that is team. There's caveats where if you've got, hardware, there's going to be maybe inventory costs. But for the most part, assume that team is what's the cornerstone. That's one, going to kind of help answer those really critical early stage questions. And two, from an investor perspective, that's what they're investing in that early. If you're raising a seed, you might have some traction and some early indicators, but they're investing in the team. So for sure, team is like the cornerstone of both expense and prioritization. I think, that starts flipping where sales and marketing expense becomes more prominent once you've got product market fit. So the idea is, if you're raising your seed round, you're getting that fire going. When you go to raise your seed round, that fire is burning. You got product market fit. Series A, the intention is you're pouring fuel on a fire that's burning. And as you get Series A, B, C, and D, those growth rounds, the intention is that fuel is really going towards your sales and marketing effort because you've proven you got the model. I spend this much on sales and marketing, I get that much output. Let's go do it everywhere. So I think it's all about the stage of the business where that flips.
Okay, so just to repeat in my mind here, you're saying sales and marketing should be at the seed or a little bit later in terms of the investment you would make in marketing and sales?
The sales and marketing becomes a more prominent equation, a more larger investment as you've proven your product market fit.
Okay.
Right?
Okay.
Because it's like the simple version is if you figured out that, Facebook ads work and specifically to this, this subcategory of people, then it's like, here you go, fire dollars and just start, dialing for dollars kind of thing. So it's all about that switch happens once you've kind of fine-tuned your machine. Again, the caveat across the board, it depends on the business too.
Right.
Some businesses it's not, AdWords. You need a person who's picking up the phone and dialing for dollars, and that's human beings that you got to hire up your team. So
yeah, for sure.
There's no sort of hard and fast rules. On the commission front, there's sort of two pieces I add because you kind of raised 2 points. One is the commission, which I think is different sectors have different appetites for commission. I'll say that much. Different individuals have different appetites for commission. I think the most important thing is if turnover is expensive and make sure your compensation structure reflects sort of a person's ability to succeed. So some industries you can go all commission because there's a track record of selling and people know that they're likely going to earn. If no one's ever sold the thing before, selling all commission, for example, is very hard. So commission is an important piece of the puzzle. Performance pay is always important, but it depends on sort of the nature of the beast and how mature your sales cycle is. The second piece as it relates to sort of, can you do that through options? Just sure. You can incentivize people however you like. I think in the vein of talent costs, options is important. And as a general rule of thumb, 10 to 20% of a cap table should be your employee stock option program, a lot of which is for founders and for sort of executives. But that's like this 10 to 20% range is kind of a bit of a ballpark. How you allocate that, admittedly, allocating on the basic commission, atypical. Doesn't mean you can't do it. It's just sort of think about the fact of, depending on the stage of the business, option plans can get very expensive and you're attracting a different type of profile. At some point, you want to pay people cash. So it depends on the business, depends on the stage. Hope that helps.
All right. And that actually wraps it up. So opening to sort of more questions, I guess.
Yeah.
I'll keep my eye on the chat and actually see if there's anyone else that wants to drop in more questions. But yeah, I mean, thank you all so much for having us here. Give you a quick presentation. Sorry for all the maths on a Thursday afternoon. But thank you to the DMZ for having us and giving us the opportunity to present. So happy to take on more questions. Also, our contact information, bottom of that slide, feel free to reach out to us.
Although those links don't look like they're going to work, but we can make sure you guys get the right one.
Yeah, I'll fix those when I send them over. But do make a note of do make a note of our addresses. Just minus the underlined part, so literally just up to the .com. That's a typo on my end. Sorry, guys. But yeah. Any further questions? Happy to answer while we're here.
Thanks, Lee. Thanks, Graham. I'll just open up for maybe one question. Just be conscious of time, but if anyone has any question, you can just unmute yourself and ask it.
My name is Hippolyte, and my question is, how do you work out the gross margin rate, or even your break-even rate? Your break-even if you are selling software or a service. Did you get a question, or should I repeat?
Yeah, like what's the formula for your margins?
Yeah, if you are selling, so do you have a way of working that out? I mean, your gross margin and your break even. if you're selling software?
Yes, the quick answer is you definitely should. I think, what goes into gross margin is a little easier because you're also including some sort of, so I'll back this up. Anything required to sell a product directly related to selling a product goes into your cost of goods sold. So if your software sold itself, literally you just sort of put it you sort of developed it and stuck it online and it just sort of sells, you would have a very, very high margin. Typically you're selling. So any active selling element is required. Obviously on software, you're not selling a physical thing. So your margins are typically much, much, much higher. In some cases, there might be licensing costs. So if you've got, costs for if you're pulling in an API that you've got to pay for, as an example, that might be a cost that's going to go into your COGS. So generally speaking, gross margins are extremely high in software, but there's stuff you're paying for. And the way to think about it is everything that's required to sell that directly related to selling those units. When you're doing contribution margin, so the separate analysis, which is really focused on variable costs, the strict variable costs for software are typically quite low. It's usually going to be cost of sales related items. So commissions is a good example. Again, licensing fees. You're not including, for example, any amortized development costs or things like that. You're also not going to be including salespeople staff. So if you have a sales team who all they're doing is selling, they're not going to be included in a variable cost in the context of contribution margin, but they may be included in your cost of goods sold when you're calculating gross margin. So there are subtle differences between the two. It relates to the behavior of that cost, if that makes sense. But in all cases, one of the benefits of software is margins per unit sold very high. If that helps. I know that was pretty ambiguous. Yeah.
It does. Thanks.
Okay, I think we can bring this to a close now, but it's been a very good session. Thanks, Late and Graham, for your time. And for everyone that has been on this call, I will be sharing the deck tomorrow when I get it from Late. And then you can also reach out to them. They will have their contact emails on that deck too. If you have any questions, you can reach out to them. And thanks, Late. Thanks, Graham. Thanks, Sweeney, for making this happen.
Yeah. Thank you guys. Thanks so much for the time.
Thank you guys.
Thank you.
Thanks, guys.